It's time for On the Radar. We ask an investing professional what he or she is looking at in today's markets. We're back with Karl Berger from Cidel Asset Management. Karl doesn't expect a recession, and he's leaning towards cyclical sectors in investor portfolios. Without getting into definitions, economic definitions, but you're not looking at sustained lower GDP.
Well, so that's where I might actually shift it around a bit,
Okay.
Andy. I could imagine lower GDP, certainly lower than it has been.
But declining, though.
And to me, whether it's a recession or not, whether it's a technical definition of a recession, whether we have minus 0.5% growth or plus 0.5% growth, it's a low growth environment.
Okay.
I don't think we expect a significant recession at this point. Employment demands are too strong still. Housing is too strong. It doesn't look like either of our North American economies are on a trajectory that would lead to a significant recession. But we're in a very, very slow growth period, especially in Canada right now, and have been for arguably a couple of quarters. So whether it's a technical recession or not doesn't really bother me one way or the other. Mm-hmm. You'd mentioned that our portfolios are slightly tilted towards cyclical stocks at this point, and that's as much a function of the valuations that were available at the end of 2022 when markets performed as poorly as they did, and some of the IT stocks, some of the industrial stocks were really suffered during 2022. That was a great opportunity to add them. Those stocks haven't necessarily performed brilliantly through 2023 because we've been sitting in a uncertain growth environment with continued monetary policy tightening. But I think as we get through that period, and you'll gather from my comments so far that I think we're through it, we should be in a place where we can look at the next 5 or 10 years as maybe not the start of the next raging bull market right now, but certainly we're starting from a point where equity valuations in the majority of the sectors that we look at are reasonable. They're not cheap, but they're certainly not expensive. Multiples are not challenging in Europe, in parts of Asia, in Canada, in parts of the U.S. They're not challenging. In the tech sector, yeah, they're still high and probably always will be. But so if you look at where we're sitting right now, and especially with the backdrop of the fixed income that we talked about in the first segment, there's a reasonable expectation for pretty solid returns from both equity and fixed income portfolios over the next few years, and I'd argue from a decent starting point here for equities that could extend out. Doesn't mean it's going to be a straight line, and it doesn't mean it's going to be smooth. And there is all kinds of geopolitical risk that investors still need to be aware of at this point, because it's impossible to tell what that path could be. But it's also really, really difficult to manage to a geopolitical risk that hopefully has a tiny percentage probability of actually happening. If it does, it's going to be horrific from so many different perspectives. It's really difficult to manage to that possibility in an equity portfolio.
Sorry, Karl, what would be horrific again?
Oh, if tensions in the Middle East escalated dramatically, for example. Yeah. So we get questions all the time, like, what if China invades Taiwan? Why are you invested? Because there's a good chance that they'll do that. Well, it's probably not a good chance that they're going to do that. It's a possibility. It's what you might refer to as a tail risk event, a very small probability, but that would have very, very major consequences if it happened. It's really difficult to manage a portfolio to cover those slim possibilities and to still be invested productively.
Now, just on cyclicals, are you talking about classic cyclical stocks like chemicals and steel, for example?
Yeah, so our highest weights in our core models right now are financials, information technology, and industrials. And all three of those categories would fall into the cyclical side of things. Consumer discretionary would be the fourth biggest weight for us across most of our mandates. And it doesn't mean that we're risk on, this is the start of the next raging bull market. It simply means that there's value. We think there's value in some of those stocks and some of those sectors, and we're comfortable to have that kind of exposure based on the economic backdrop that we think is unfolding. And that's primarily a halting of the monetary policy tightening that we've seen over the last 2 years or so.